So for this video, I want to cover all the different options you have to get paid out of your LLC. Right, so what I'm going to cover are the different types of compensation. So these are the various methods you can get cash out of your business. And then we're going to cover the various options depending on how your LLC is taxed. So not everything that I'm going to go over applies to every single type of taxable entity. Some are going to apply to many, while others will apply to only maybe one or two. So if we start with the first slide, different types of compensation here. The first one is just wages, right? So if you're working for the business and you want to draw a salary or some type of equivalent, you can get paid compensation as wages. The second one is owner distributions, right? So if you're an equity owner in a company, you can draw cash out of the business as an owner draw or a distribution, and you can get paid that way. The third one is loans to owners, right? So if you are an owner and let's say there's excess cash in the business, but you don't want to take it as salary or a distribution, you can actually borrow money from the business. So the business can loan you money and you get the cash that way, and that is one other option. The fourth one on the list are dividends from E&P. E&P meaning earnings and profits. Right, so this one, we're going to see it only really applies to the C-Corp context. So if a C-Corp has accumulated earnings and profits, you can take a dividend distribution from the company. And then the last one is selling equity back to the company, right? So the company can actually buy back portions of your LLC membership units. And obviously, if they're paying you, you're going to get cash that way. Okay, so let's talk about the first one, the single member LLC that's disregarded. So an LLC that's formed by just one owner is by default a disregarded entity for federal tax purposes. What that means is that the LLC still legally exists under state law. It's a business, it provides you that liability protection, but the IRS just completely looks at it as a transparent entity for federal tax purposes. So whoever the owner is the one that's responsible for reporting everything directly on their tax return. Now, if this is an LLC owned by an individual and you're conducting an ordinary trade or business, generally that means all the income and expense is going to be reported on a Schedule C, right? And you pay tax at the individual level on your Form 1040. Tax implications very similar to sole proprietorship. So when we think of a sole proprietorship, it's an entity it's not an entity at all, right? It's an individual that just decided to start a business without forming a legal entity. So if you form a business without a legal entity, let's say you just register for a DBA, you're a sole proprietor. Again, all the income and expense is just reported directly on your tax return. Now, how do you get paid when you're running a single member LLC that's a disregarded entity? Well, because it's disregarded, everything is just flowing through to you automatically anyway. So for that reason, you can just take money out of the business bank account whenever you want to pay yourself. You don't need a formal payroll set up. You don't need to have any kind of formal distribution schedule or kind of timeline set up. You really just take the money out, deposit it from your business bank account into your personal bank account, and then that's it. And again, there's no need to have a formal payroll setup. Now, if you have employees, then you would have employees that you prepare and file payroll tax returns, 941s, W-2s, and the like. But if it's just you and you're running a disregarded entity, you can go ahead and just, again, pull the money out, and then that's it. Very, very simple. There's also no need to loan money from the business to you, right? So on the previous slide, I talked about how you can borrow money from the business. In this case, there's no need to do that either. Because it's completely disregarded, there's no need to borrow money from your business bank account and then pay it back. Just take the money out, and then that's it. Okay, so let's move on to the next one, covering multi-member LLC. So a multi-member LLC is exactly that. It's an LLC that's formed with two or more owners. And under the default rules, that means it's a partnership for federal tax purposes. Now, a partnership files a Form 1065 every year, and each partner receives a K-1, which shows their allocation of the income and other tax items that occurred at the partnership level. Okay? Now, what's important here to remember is that partnerships are pass-through entities. What that means is that the income is going to be subject to tax on purely just the allocation, right? So it doesn't matter whether you as a partner actually get any cash out of the business. If the partnership does, let's say, $1 million in net revenue, sorry, $1 million in net profit rather, and then it allocates that to the partners have to pick up that income on their personal return and pay tax, even if there was no cash paid out to them during the year. So how are partners in a partnership normally compensated? Well, it's generally two ways. The first one is just cash distributions. So if you're a partner, you can receive a cash distribution, a cash withdrawal. So the partnership pays you cash, and the cash payments that you receive, the cash itself isn't the taxable piece. It's just a reduction to your equity. Because again, remember that the allocation of income to you is what's going to be taxable, not how much cash you pulled out of the business. But the cash obviously is what you need to pay yourself, pay your bills, so you've got to get cash out of the business some way, and that's generally how it's done, is you receive a cash draw from the business, and again, that piece isn't taxable, but it is a reduction to your capital account. The second option, which is not too common, but we do see it in some cases with multi-member LLCs where some people are working for the business and others are not, is guaranteed payments. So if the LLC operating agreement provides that, let's say you've got a 10-partner LLC and only 2 people are really working for the business, and so they're the ones that are going to be paid a, quote, salary, they can receive what's called a guaranteed payment. So the LLC operating agreement will specify that such and such individual is going to receive, let's say, $10,000 a month as a guaranteed payment, and that cash payment occurs regardless of the profitability of the company. So the guaranteed payment is kind of like a salary for the partner. It's a deductible expense at the entity level, and then the partner that's paid that amount records it as income. Okay, and so the third one is the loans to the owners. So the loan amount, again, so what we're talking about here is that the LLC has excess cash, and rather than distribute it to the partner as a guaranteed payment or a distribution, a draw, which reduces their capital account, they can loan the money to the partner. So if money is loaned from the business to the partner, it's not income to the partner, and it's not an expense to the business either. The loan amount should be documented. There's got to be, regular payments of interest and principal. It's got to look like a loan. What you don't want to do is have it not documented or no interest that's being paid or accrued, because then the IRS can come in, they can actually challenge the characterization. They could say, well, this isn't really a loan. This should just be, a distribution of some kind. So very important, if you go down that route, make sure it looks legitimate, or else the IRS, if you're audited, they could change it. Now, the one drawback with this is it can create phantom income, phantom interest income, right? So what we mean by that is if you set it up legitimately, now the partner has to pay interest and principal into the partnership. The interest that's going into the partnership is now going to be taxable interest that's being allocated to the partners. And so this can create kind of a phantom income where you're basically creating more income than you're paying more tax just by moving money around between the entity and yourself. In some cases, this does make sense to do it, but it's just something to kind of be mindful of if you do decide to go down this route where you're just going to loan money from the company to yourself, because when you do pay back that interest, you're going to have to record it as income and pay tax on it. Okay, so let's move on to the next one here for LLCs that are taxed as SCorp. So an LLC, if it meets all the eligibility requirements from the shareholders, can elect to be taxed as an SCorp. All right, so again, remember, LLCs that are SCorps, you can only have 100 shareholders. They all have to be natural persons that are U.S. tax residents. And if you meet those requirements, the LLC can make an S election. Now, if the S election is made, the entity is now filing a Form 1120-S S-Corp return, recording the income, expenses, and then it allocates that out to the shareholders on a K-1. Now, the LLC, very similar to the partnership structure, is it's a pass-through entity, right? And so because it's a pass-through entity, all the income being allocated to the shareholders is going to be subject to tax, regardless of whether the shareholders actually get any cash out of the company. Okay, so obviously in order to pay the tax, you're going to need some cash, so let's talk about how you get paid. Well, the first one, very similar to the partnership, is just cash distribution. So cash draws, which are, again, a reduction to your equity in the company. But in this case, because we have an S-Corp, we refer to it as your stock basis. So partnerships use capital accounts. S-corporations track their stock basis. Again, the cash coming out is just a reduction to your stock basis. The cash itself isn't the taxable piece. It's the income being allocated to you. For S corporations, so the second piece is just being a salaried employee. So what's different between the S corps and the partnerships is S corporation shareholders, if you are a greater than 2% shareholder and you actively participate in the business, you should be a salaried employee. And if you're a salaried employee, it means you need to be paid what the IRS considers to be reasonable compensation. What's reasonable depends on the business, how many owners there are, what you're doing. So it's a very gray area, but you need to be on the payroll. And so that means that you're going to get a W-2 at the end of the year. You're going to have federal income tax withholding. You're going to have payroll taxes paid. You basically are just an employee, just like all the other employees for your business, but you're also an owner. So the third one is, again, loans to the owners. So this can work similar to the partnership structure where the business can loan money to the shareholder. That's fine. But it's got to look legitimate. It's got to be documented. It has to be stated interest at reasonable rates. There have to be repayments made by the shareholder back into the company. And again, the interest that's being paid into the company is now interest income recorded at the entity level, which is then allocated out across to all the other shareholders, and they have to record it as interest income. So you have the same kind of phantom interest that's being paid similar to the partnership structure. Again, it can work. In a lot of cases, it makes sense to go down this path, to have the loan arrangements, even though there might be interest income. But something just kind of keep in mind is, again, this kind of phantom interest income tax that you might have to pay if you go down this path. Okay, so let's move on to the last one here. LLCs taxed as a C Corp. So LLCs, again, they're eligible entities, so they can elect to be taxed as a C corporation. If the LLC files that election, it is now a taxable entity, and it files a Form 1120, and it pays tax at the entity level. So unlike the previous two, this is no longer a pass-through entity. It's taxed as a C Corp. So the LLC prepares the 1120, reports its income, expense, and then it pays tax at the entity level on a net basis. As of 2022, the tax rate at the corporate level is 21%. It might change, but for now, you're looking at 21% on the net taxable income in the corporation. And then, if any earnings are left over, they can be distributed to the shareholders as a dividend. And again, dividend income, when it's being recorded at the individual level, is also subject to tax. So this is the famous double taxation issue you hear about with C corporation structures. So if you're a C Corp shareholder and you are actively participating in the business, how do you get paid? Well, similar to the previous two, you can be paid as an equity owner through cash dividends, right? Now, what's different about this is if the corporation has cash available to distribute a dividend, the dividend itself is also going to be subject to tax when you record it at the individual level, right? So the double tax issue. But again, that is one method of compensation. The second one is to be a salaried employee, similar to the S-Corp structure, right? So if you actively run the business in whatever capacity it might be, you can be an employee, you get paid a salary, you have federal withholding taxes coming out, you have payroll taxes coming out. You look just like any other employee. Now, what's interesting about the C Corps is they also have reasonable compensation issues like the S Corp, but it kind of goes the other way. With the S Corp structure, reasonable comp, it's often where you want to kind of keep your salary lower to limit your payroll tax. In the C Corp structure, the IRS comes in and often challenges the compensation of being too high, right? So why would you want to pay yourself too much as a salaried employee with a C Corp? Well, because of the double tax issue, right? So C corporations are paying tax at the entity level, and then the dividend is taxable again when you draw it out and you pay that at the 1040 level. So oftentimes, sometimes you can actually save money by increasing your salary because it increases the deduction at the corporate level, so it lowers the corporate income tax, and you don't have to pay the dividend taxes if you take a dividend out. So sometimes it does work that way where you can actually increase your salary and pay less tax overall rather than reducing your salary, paying corporate income tax, and then paying tax on the dividend income coming out. Okay, so third option, similar to the previous ones, loans to owners, right? So if you're a shareholder, instead of taking a dividend, instead of taking salary or bonus, you can take a loan. If you take a loan out of the company, same principles apply as before. The loan has to be documented, it's got to be reasonable rates, reasonable repayment terms, and similar to before, the interest that is being earned within the entity is going to be subject to tax. So if you borrow $100,000 and you've got to pay back $105,000, the $5,000 of interest income is going to be recorded on the corporate tax return, and you're going to pay tax on that $5,000 of interest. Okay, so again, it can work, but you're basically increasing your tax exposure by having to pay this interest. So that's just the nature of the game. And then the last one here are selling LLC units back to the company, so creating treasury stock. So just high level, what treasury stock is when you have a C corporation structure, the corporation can buy back stock that's outstanding, so it can buy back a portion of your LLC units. And the LLC units that are bought back are now treated as treasury stock on your balance sheet. So it's a reduction to your equity. Now, if you sell your shares back to the entity, you get cash for it, right? You sell it for X amount of dollars. The company gives you cash, so you get cash out of the business that way. Now, the one problem with closely held companies, and this would apply to most people probably watching this video, is that under sections 301 and 2, we have these disguised dividend rules. So normally when you think of selling stock, you get capital gain treatment, right? So I have stock valued at $10. I sell it for $30, I have a $20 capital gain. If you sell stock in this fashion and you're only selling a small piece, because remember, you don't want to give up the whole company, you just want to sell a little bit to get some cash out. If you're selling just a piece, what will happen is you won't get the capital gain treatment. The look-through rules here say, well, that's effectively a disguised dividend. So rather than get capital gain treatment, you have to treat it as a dividend. So now it's going to be subject to ordinary income tax. So it is one way to kind of get money out of the business, but it's not the most tax favorable way. Okay, so again, it's on the table, it's an option, but before you go down the route of trying to sell LLC units back to the company, if it's taxed as a C Corp, be very careful to look at these rules and make sure that you are getting the favorable tax treatment. Otherwise, what's the point? Okay, so that covers it. I hope that was helpful. If you have any questions, please leave me a comment below, and I look forward to seeing you again on the next video. Thank you.